Hi everyone. Navigating loans can often be difficult when you're encountering new loan lingo, experiencing the loan application process maybe for the first time, and so much more. So today we're going to be talking about some loan basics. My name is Maria Hamill and I am the online learning specialist here at Trio Student Support Services. So again, today we're going to be talking about some loan basic terms, different types of loans and your credit scores. The basic loan terms we're going to be going over today are cosigners, credit scores, default, principal, interest, and APR. A cosigner is someone who agrees to pay back the loan if the primary borrower does not or cannot. According to Experian, a lender may ask you to add a creditworthy cosigner to your application for the loan if you don't qualify on your own because of credit or your income. Adding a cosigner with a good credit score can sometimes result in a lower interest rate. This is because the responsibility and obligation are now spread across two people or multiple people. Some examples of cosigners are often the borrower's close friends or family members that can help them include them on the loan. A credit score is a score from 300 to 850, and this is used to determine how likely you are to pay back your loan on time, according to the lenders. Default is failure to pay back a loan. This might result in the lender or the bank or whoever you are borrowing money from. They may take that item that you're using the loan for from you. So, for example, if you default on a loan, they might take the car that you're using to pay for that loan with. Right, next up is principal. So principal is the amount of money being borrowed. So let's say I'm asking the lender or the bank for $10,000. That is the principal amount. Interest is the percentage the lenders charge you to borrow the principal for the principal amount of the loan. So maybe the interest rate on my $10,000 loan is 2%. APR, or the annual percentage rate, is the total cost of the loan expressed as a percentage. All right, so in the next few slides, we're going to go over some examples of and kind of break down APR, because APR is a little bit tricky. So when it comes to APR, we all want the lowest interest rate when shopping for loans, right? But according to Discover, if we're just looking at the interest rate, we might not be getting the full picture of the amount of money you will owe over the lifetime of the loan. So the interest rate only calculates the cost of borrowing the principal. The APR includes the interest rate plus any other expenses or fees that are a little bit hidden and aren't explicitly stated for the interest rate. So these fees can add up and you might owe more than you're expecting over the lifetime of the loan. So let's go over an example here of what that might look like. So let's say our loan amount is $18,000. We have an interest rate stated of 12.99%, and the payment term is 60 months. However, there is an origination fee that is included in this loan that, looking at the interest rate, we wouldn't know about. So let's say that origination fee is 5%. So obviously there's, additional fees added on for this loan that we didn't know about. So that's going to increase the APR. So now the APR is 15.18%. So viewing the APR over the interest rate is what I would recommend, because the APR is going to be the real number that you will eventually pay over the lifetime of the loan. That might show that will show some hidden fees or origination fees that you're not aware of if you're just looking at the interest rate. So my recommendation is to look at the APR, because that will give you a full picture of the loan. If you're following along on the online module, we will pause here and we will move on to the next web page. All right, so we're now going to jump into some types of loans. We're going to discuss personal loans, student loans, auto loans, and debt consolidation loans. I want to preface this section by saying this is a high-level overview of the different types of loans available and how they work. I do encourage you to do more research when it comes to choosing the right loan for you, because everybody's financial situation is different and unique, but this is, again, just a high-level overview to give you a little look into what these different types of loans look like and how they work. First up is personal loans. So this is money to help you pay for large purchases. Maybe this is some examples of this would be an engagement ring or home repairs that you don't have the initial funds for at this very moment. So it's just kind of extra money that you need throughout your lifetime. And this is money that you maybe don't want to put on your credit card. Often personal loans have a lower interest rate than credit cards, so this could be a good option for many large purchases you might be needing. So how it works is you can apply for a personal loan through your bank or other lenders in the industry. As a side note, I do want you to be cautious and do your research about the institution that you want to lend for a personal loan before handing over any of your personal information. I would hate for you to get scammed or it not be what you're expecting and have a higher interest rate than you were expecting. So once you are happy with the interest rate, APR, and all that the lender is offering you, the money will then be deposited into your account, maybe like your bank account, for your disposal, and you will pay back the principal plus the interest every month based on that loan term. So again, it's just additional money to help you with some large purchases that maybe you don't want put on your credit card. Student loans is up next. This is money to help you pay for a higher education, such as maybe college, university, or trade schools. Interest rates are often fixed and lower than private loans. So when I say an interest rate is fixed, so is likely not to fluctuate rapidly over the years, from year to year, or even semester to semester. It stays pretty consistent. And you do not need to pay back your loans typically until after you graduate. Student loans are based on need or eligibility for a loan. To apply for a student loan, you must fill out the FAFSA, which is the free application for student aid, to receive money from the federal government, which is the most common way that folks pay for their education. And for additional information on how to apply for the FAFSA and all of that, feel free to check out my prior module titled FAFSA in our online module web base for more information on how to apply. Auto loans are a lump sum of money to help you purchase a car. Until you pay back the loan, I do want to mention that the lender does hold the title of the car. So that means that they do, in legal terms, own the car until you do pay back the entirety of the loan. And failure to default on payments or fall back on payments, the lender can repossess the car or take it away from you. So making sure that you're able to make those payments and is in your budget to pay those payments are very important. You can apply for an auto loan through your bank, the car dealership, or other online lenders. If you're using online lenders, just make sure that you are doing your research about them and you are happy with the interest rate and APR and all that jazz. Lastly is some debt consolidation loans. So this is a personal loan that combines multiple debts into one loan with a fixed interest rate. So maybe you have a credit card and a mortgage and maybe a personal loan, and let's say they all have different interest rates, and maybe it's difficult to pay all of them due to different varying amounts of interest rates and things like that. There's a way through debt consolidation loans, is to combine all of those loans into one and have one interest rate that you're now paying off of. This can be really beneficial for some folks and is a great option for them. I do want to mention that you cannot use debt consolidation loans for student debt or student loan debt, and you do have to have a high credit score to be eligible. So just do your research if this is something for you, and ask, your lenders and your banks if this is a good option for you. If you're following along on the online module, we are going to pause here and move on to the next webpage. All right, so you likely hear people say it's good to have a high credit score when you're applying for a loan, but what does that even look like, or what does that mean? So today we're going to discuss how loans affect your credit scores initially, and then why lenders think it is important for you to have a high credit score. So I first want to start off in letting you know that there are two different ways that a credit score is calculated. They are through the FICO score and the Vantage score. As you can see here on the screen, they are calculated a little bit differently just by those numbers that you can see, ranging from very poor to exceptional credit. So that's the first thing that's a little bit different between them. This is just kind of two companies that do credit scores, and they determine them and calculate them. This is more just kind of information for you to know that there are two companies that calculate credit scores, pretty much. If you want to do additional research on this, feel free. We're just going to do kind of a high-level overview of credit scores. So first off, how does applying for a loan affect your credit score in the initial stages? So when you are applying for a loan, the lender is going to do a hard credit inquiry. So this is a request from the lender to view your credit report through that FICO score and that Vantage score. They are going to reach out to those companies or those credit reports and ask to do a hard credit inquiry. So in other basic basic terms, that they're asking to view your credit score. By doing a initial hard credit inquiry, there will be a small temporary decline in your credit score by doing this. Unfortunately, there's not something we can get around when someone is looking at your credit score. It happens every time. I do want to mention that due to this temporary decline, you can get it back up again. The good thing about credit scores is that they're ever changing, and we'll talk about in the next slide, some advantages to having a high credit score, and how to get a high credit score. So the good thing about this is that it's small and it's temporary, and people who are doing the lending know that they're going to be a small decline in the credit, in your credit history, so they likely won't hold that against you. So, as I mentioned before, why is it important that we have a high credit score according to lenders? First, it's important to know that there are many factors that affect your credit score, such as payment history, the amount that you currently owe, the length of your credit history, so how many years have you been lending or asking for loans, any new credits that you have, your current balances, any available credit that is available to you. So kind of a mix of different options. And you can see here on the screen that it's a little bit different according to each credit company. So the FICO and the Vantage score, they calculate their scores slightly different. So that's how they calculate scores. Again, if you're interested in learning more about how credit scores are calculated, I encourage you to do more research into this. This is just high-level overview. So as I mentioned earlier, lenders like to see a higher credit score, and they believe that you're more creditworthy if you have a higher credit score, because they believe that you are more likely to repay your loans on time. It is best to have a higher credit score if you can, as it will help you increase your chances of getting approved for a loan. It helps increase the amount the lender is willing to loan you, and it often helps you get the best interest rate and lots of other advantages. I do want to state that even if you have a low credit score, there are still lending options available for you. We mentioned earlier in the presentation that cosigners might be helpful if you have a lower credit score on many different lines of credit. So I would encourage you to speak with your lender on the different options that are available to you. So it's just kind of a FYI when it comes to credit scores, to be in mind of it, but don't let it take over your life. This is something, a credit score is something that's ever changing, and we can always work on it throughout your lifetime. Thank you for following along today. Hope you learned something new about credit scores or loans. If you have any questions or concerns, would like to talk more about this topic with us at TRIO Student Support Services, please feel free to reach out, and we are more than happy to discuss it with you. Thank you and have a great day.